Welcome and good evening, everybody. Today we'll be discussing a little bit about trading in volatile times as we are living in. Now, before we get to the actual webinar, as always, please take a moment to read through the risk disclaimer. Yeah, it should be long enough. All right. So, what we're going to discuss today. Well, firstly, I'll explain a little bit about me for those that are new, who I am, what I do. Pretty much me in a nutshell. Then we're going to discuss a little bit about volatility, the good and the bad about it, from a trader's perspective, right? From a retail trader's perspective. And then we're going to go over some tips and tricks, just basically general tips and tricks that I have that are a little bit generic, but also some that I just implement myself when I was going through 2012, 2008 that worked for me. So how you can kind of benefit from things and sharpen up your game. And then for those that are in the webinar, at the end we'll have the Q&A, and that's probably going to be the meat of this webinar for those. Really try to answer your guys' question, what you would do in certain situations, because there's only so many scenarios I can come up with. All right, so that part won't be in the YouTube video if you're watching the recording, but there we go. All right, so about me. Well, my name is Mike Velting. I live in Athens in Greece. I'm originally from the Netherlands. I'm Dutch. And I've been trading the Forex for about 15 years. This kind of started for me when I was 19. I was studying in the Netherlands under BTEC, which was a Cambridge program under Delft College. And I was always decent with numbers and figures and then analytics. So I kind of stumbled upon something that now is known as Forex. And like most of you at the start, hey, this sounds interesting. You might be able to make some good money with this. And, obviously eyes much bigger than your stomach and thinking that, I got this. I'll get rich in no time. Watch a few videos. I got this. Yeah, no, you don't. Obviously that blew up in my face once or twice. Then I decided okay, but there is something to this. So I threw everything I thought I learned into the bin. And I started from scratch. And I started really learning all the basic stuff from scratch, understanding why things are done that way, understanding how the markets work, and then from there slowly understand how to play that game. Fast forward that 15 years, yearly consistently profitable account allowed me to rotate a little bit out of it, which brings me to what do I do? So for about the last 6 years, on and off, I've been requested to do these webinars. I've done some for myself. This is just kind of an angle for me to, provide you guys with some information, some things that help me out, get through the start, and also some, webinars that are more advanced. Just things that worked for me, and hopefully avoid some of you, running into certain brick walls, and clarifying maybe some of the issues that you run into. Obviously, that ties in with mentoring. A year ago, I started also with my CSI, which is a financial advisory, course, licensing, I should say. That's in progress. I mean, it's a little bit something I do on the side. It's just more for myself to get a better understanding on the institutional side of investing and corporate investing and that kind of stuff, to have a better understanding how that market really works. And yes, I'm involved in other projects, of course. I get requested a lot for different things, looking over like investments, looking over, usually it's financially related stuff, but it can also be other things like startup businesses and stuff. So that's me in basically general. Now, let's get to what you came here for. So volatility, good or bad? Well, we'll have a conclusion at the end of this, but let's talk about the good part about volatility. So I say your accelerated gains. What I mean by that is when there is volatility, which is our lifeblood, right? Retail trading lives for volatility. It is the main thing we want to have in a market. If a market doesn't move, you can't make money. You need to have a market move. That is a two-edged sword, right? Because it can move against you much faster as it moves with you. But when you are consistently, trading in the right direction, by some of the tips and trips I'll do later, and having a good fundamental basis in how to approach your trading strategy, how you amend it during volatile times, it allows you to really accelerate the gains that you get, because obviously the market moves the same amount of pips in a much less shorter time frame. So this is definitely a benefit, and it's basically what we as traders should live for. As scary as volatility can be, it's basically what you want to see, right? To put that in simple perspective, let's say you're trading Euro CHF, name something, and it's trading between 1 and 1.02. And the channel is going, let's say it's an uptrend, and it goes from 1 to 1.05 over the course, I don't know, of 3 weeks. What can you really get out of that, right? So this is what you need to understand. Like, having big spikes up and down, although they're scary, they can help in your trading when you approach them good with right risk management, stuff like that, which we'll get back later. Obviously, that ties in with increased opportunities, because the market tends to swing a bit more during volatile times because of indecision, because of a lot of volume switching when people buy and sell at different points. And obviously big gains means people close out faster, they get a bit skittish, especially retail traders. For most big institutions, their positions are held, they factor in certain price ranges, and they don't close positions early unless something really goes different than expected. But generally speaking, for them, the approach is time in the market and not timing in the market. We rely on timing in the market, so we need to look for more opportunities, and volatility allows you to get more opportunities more often, right? So especially when you have a smaller account, so anything under $2,000 or pounds or whatever, you really need to consider, like, you need to pick your trades. You cannot simply trade everything. Even if something is a very good solid trade, it might be in a position where it just does not allow you to take that trade because of restrictions on your capital, and thus the risk you would have to take in order to correctly set a trade up like that with stop loss, for instance. So by having increased opportunities, you have during the week literally more opportunities to take different positions that you can pick and choose easier. Right, so that's obviously a good thing, which increases your frequency, right? They're all tied into each other. So the frequency allows you to trade more often in a shorter time frame. I don't mean time frame on the chart, but I mean the trades develop and end faster, allowing you to do more trades in overall. So if you would have a standard portfolio of 5 to 10 trades active at any given time, you're rotating through these trades a lot faster. Now, although a lot of you are going to say, I just do one trade at a time. I know that's a whole different story. But basically, when you learn how to build a portfolio, you balance out a trade where you have a good broad thing. We'll discuss exposure and risk management in a little bit. These are things that help you stabilize and diversify your account. So what happens is you're rotating through this whole portfolio faster. And it means that you can switch to your backup trades or your alternative trades over and over and over. So the whole thing of volatility is basically it accelerates the account when done right. Right? When done wrong, you blow it up. Right? We can't ignore that side. So with tips and tricks, we'll talk about that part. So what is the bad part about volatile markets? Well, usually the volatility generally stems from fundamental influences. So not necessarily fundamental drivers, it could be that, right? But generally speaking, if you look at the economic calendar or geopolitical things, a good example is right now, like Russia, Ukraine, and how NATO is involved, and thus Europe is involved, and the stance of the USA. Heck, even Switzerland, after 500 years, finally woke up and decided to actually speak up for a change. Right, and then on the other side, you have China fighting Taiwan, and then you have there's a little island called Australia stuck somewhere in the right bottom corner of the world that is kind of looking and thinking, what should we do? So obviously, we cannot do this on a technical basis. There's no way to plot out for these things. So the bad side of that, because retail trading is more geared towards technical trading, generally speaking, there is fundamental trading as well in retail, but the bad about this is that it usually goes into a water where a lot of people are uncomfortable and a lot of traders aren't that familiar with how to read this, which means that it's hard to predict what markets are going to do and what levels can they go to, right? So you have like these consistent breakouts and fake breakouts. How do you calculate these limits? I mean, some people say like, oh, you use Bollinger Bands. Yeah, but it can go outside of that range pretty easy if you consistently get an increased volatility. Then the bands just keep expanding and you still don't know what the range is, right? So it's more about learning how to judge the correct direction more than judging the right level. Right? You need to plan ahead and think about what the market is doing. And because of if it's negative or positive in the volatility, it becomes much harder to judge entry points because trends aren't as stable, right? They don't have their normal zigzag pattern. They have like these jump outs. So that makes the entry point judgment a little bit harder to do. Um, what it does allow is, you can extend your take profits a little bit. What you shouldn't do is cutting in your take profits because you need to consider you have a bigger range, right? So by extent, you don't want to start taking more risk just because I don't want to get wicked out, right? Remember, you're doing volume now. And if you're not doing volume, you're picking your entries different. We'll discuss this a little bit more in detail in the next slide. And we're going to go to the chart and I'll try to drop some scenarios. So because things don't have this consistent zigzag formula, or it might be Elliott wave principle if you use that, but what happens is you get these spikes, and because of these spikes you don't really get determined levels and determined channels that you can really judge, okay, crossing point X, Y, and Z. So things like price action kind of starts falling away, and then because of this it becomes kind of it starts to feel like you're guessing what's going to happen next. There are a few pointers that I want to point out to that. It's like, how would you look at trading this market? All right, so overall, as a conclusion, volatility is good. And the reason for that is literally because it allows you to actually make trades happen, right? It's instead of, you set up a trade and it takes 48 hours to develop, you set up a trade, it takes 4 hours to develop the same amount, right? That's kind of what volatility does. So it allows you with more opportunities, which is great when you have especially a smaller account, because when you have to be picky about the trades you get, the more opportunities that present themselves over a week, the more opportunities you have to pick and choose. It's that simple, right? So that prevents the restlessness. It does make it a little bit more scary to pull the trigger from time to time, but we'll get to that in the next one. Okay, so this slide's we're gonna be stuck around for a while. So the first and foremost thing, when a market is super volatile, as it is right now, normally you would make your analysis, you would make your judgment, you judge your entry point, you pick your stop loss, you pick your judge where your stop loss would be, and from that point onwards, you calculate your lot size based on the percentage risk on your account that you want to take on your capital that fits in your strategy, and then, okay, you judge the take profit, right, based on your technical extrapolation. Well, now you want to double and even triple check every single aspect of the flowchart in your strategy to make sure that you have double checked and ticked all the correct boxes before you open that trade. Because like I said, volatility means that it moves faster, so you have less time to judge and interact with the development, right? You can't wait for trades to hang around in withdrawals. You can't have in down draws. You can't wait that much, and you're not going to marry your position either because it's just over too fast. So it's just, you have to be more considerate about every single trade that you make and really double check. Like if you're not sure, write down, this is what I say everybody, when you have a strategy, write down the list of checkpoints, the float chart of your strategy before you open a trade, your entry point strategy. Put it on a sticky note and slap it on the wall next to you or on your desktop or whatever, so you can literally use a checkbox like you would take a plane before you take the plane off the ground, you double check the checklist and then you take it, right? So it's more important to do that now than ever. Now, like I mentioned, obviously, retail trading is generally more geared towards technicals. So it's more and more important to now actually learn yourself how to track fundamentals. Now, fundamental drivers are a completely discussion on their own. The aspect of central banks, the aspect of, import and balancing of trade and general economy of a company or a country, sorry. But when we move those aside for a second and we take a look more at the economic calendar, what's really happening on that aspect, are numbers starting to be affected, right? So for instance, oil reserves in this case, looking at gold supplies, looking at stuff like that. In a market like now with Russia-Ukraine going on, you need to look at these core principles and start to recognize whether or not there is a declining or increasing trend in that, because that is going to reflect with a delay, is going to reflect into the trading behavior into the market. Right, so it helps you look at that a little bit. So if you have legacy effects, they have under trading tools, right, the economic calendar. And this is going to be your bread and butter that you should double check and triple check before you open the trade again, whether or not there is going to be an announcement in the next 48 hours at least for the pair that you're going to trade. So if it's euro US dollar, you want to double check if there's any euro or US dollar news within the next 48 hours of your trade. Right? Even if you say, okay, well, I day trade, I only do 24 hours. You need to understand that bigger traders generally start to pre-position their trades way before the announcements because they factor in the trades. Right? It could be a natural hedge. It could be a double down on their current position because of prediction. Right? So there's a whole bunch of stuff going on there. It could be because of certain price points that the market's at, where they're going to be judged where there's a lot of volume for pending orders that is going to hit, where it's going to flip the volume, these kind of things. So you have to really keep in mind, okay, I triple check my entry point based on my normal technicals. My indicators are all lining up, so there's that. Now, I know price action is not really valid at the moment because there's way too many spiking going on, so you can't really get a pattern out of it. Sometimes they still represent themselves. We'll get back to that in the examples a little bit later. But the biggest point is let me just triple and double check. Hey, if I open the trade now, when is the next announcement for that specific pair, either euro or USD, for instance, in this example? It could be pound yen, it could be whatever you're trading, right? Oil. Now, having that said, this is a good moment to learn this for yourself because it's a habit that you should pick up. Because I'm sure some people are gonna recognize the next sentence. I open a trade and 2 hours later it hits my stop loss because of a spike. And then you check and you find out it was an announcement. Hands up, who's had that? I guarantee it, there's at least a few of you in there. I'll put my hand up because I definitely at the start had that too. Come on, who's brave enough to admit? Who has this that sounds familiar? Right, so you open a trade, you did everything, and then 2 hours later, bam, it hit your stop loss because some spike or some movement, and you're like, shit, completely forgot to check the economic calendar. Yeah, 30 minutes later, an hour later, yeah, exactly. Right, so this is, apart from in volatile times where it's extra important to double check this, because it also allows you to start recognizing patterns, trends within the fundamental announcement numbers, in the economic numbers of, hey, something is developing and it's going negative and it's getting bigger and bigger, which means that it's weakening the currency. So if that's the case, hold on, you're obviously less inclined to take a buying position, even if the trend is, I don't know, at the bottom of the channel and it's slightly moving up. You know there's going to be more selling pressure down the line, right? So you're like, okay, hey, let's think ahead. Maybe I should wait for it to go back up and not trade the way back up because that's a bit more risky. But if it does get back up, then it's more secure to trade downwards, right? Take the sell, because there will be more selling pressure than buying pressure, right? So this is the logic approach, and I mentioned this in a smaller account and a bigger account. Like a bigger account, you have the room to do both ways. In a smaller account, so anything under 2,000, let's say, you should really pick only the trades that are more consistently in your probability of winning, right? So what that means is if it's a selling trend, you should only look for selling opportunities, which means at the top of the channel. We'll get back to that in the chart in a minute, right? You really pick and choose. So yeah, economic calendar, right? Pretty straightforward. So you check it, you double check it, make sure that there's nothing in the next at least 24 hours on your pair that you plan on opening something on. That's checkbox number one for the fundamentals. The other part of this is obviously the general economic and geopolitical movement that's happening, that's creating the volatility, right? Ukraine-Russia war is not exactly a figure in the economic calendar. The effects of those sanctions, the effects of how that reflects world trade, the effect of that, like COVID still running, like that shows up, right? In unemployment, that shows up in payrolls, that shows up in bank policy statements, that shows up in, right? So you will find that there. But you also need to know what's going on right now. So what I usually have is on a different monitor if you have that, or otherwise, on the background in a tab, have Bloomberg running, or any of those kind of news outlets, like investing.com, Financial Times. Obviously, I mentioned Bloomberg. Right? It's important to keep track of what is generally speaking happening in the economic sector. How are banks moving? How are people reacting? How are big companies gearing up? How are they setting themselves up? And more importantly, how are big investment firms currently analyzing the situation? Generally speaking, we don't care about them that much because their trading position is time in the market, right? Right? We were talking about structured notes, that those are positions that hold for 6 years. Like, we don't hold trades for 6 years. Let's be reasonable. A lot of people don't even hold them for 6 hours. So you need to understand that there's a different way of trading, but what is important is understanding how they are understanding based on obviously way more information than you can gather on your own, because they have all analytical teams behind them, what they expect the markets to do, how they're kind of setting themselves up, where they're looking at. You don't need to reinvent the wheel. These bigger companies, yes, they make fails as well, but in generally speaking, they're still there. They're still trading, and they're trading big, even bigger now, right? So there is a reason behind the way that they approach things. So it's good to understand how bigger companies are setting up, right? So, for instance, knowing that, shares might go down or up when Apple or, well, actually, McDonald's is a good example. McDonald's say we're going to close all the branches in Russia, right? As a sanction, as a boycott. Well, this has an effect, right, for McDonald's, right? So if you're trading stocks or CFDs like that, this is very important that you know what these companies are doing, because their policy making and their decision making is going to be reflected in the pricing in their stock. Could be up, could be down, depends a little bit on what they do. But overall, obviously for McDonald's, although it's like, from a political statement, very nice, from a profit point of view, they'll lose an entire country, and not a small one either, right? So that has an effect. Now, this is where we're going to get into the chart a little bit more, because I know you guys were waiting for that. So now that we have all these little aspects, obviously, I'm not going to run through them one by one, but wait, hold on, my thing is doing weird. No, there we go. All right, so why do I say risk management is key? well, it'll be a little bit obvious that risk management is the center of trading during volatility. Apart from, it's not about, hey, let me gung ho and just completely avoid trading or double down on everything that I think is bad or that I think is good, even if it's going bad. And, if I have a buy and it's developing very nicely, let me just add another 6 buys to that position. Right? This is not smart. Right now, you're almost doing martingale. So, and then there's people like, well, it's going down, right? And well, it means that it will swing soon because usually these markets recover. So I'm going to take buying positions every time it gets to a new low. Why are you trying to beat the system? Yeah, you're not. I'm going to outsmart the market. Just ride the train. For every time the train presents itself with a new entry that allows you to trade in the direction of the train, and then when the train changes, you're going to lose that trade probably, but you've won all the other ones because you weren't trying to beat the system and predict, because now you're almost swing trading, except you're swing trading in volatile times with a small account, most of you. For those that don't have a small account, obviously, it works a little bit different. You could do a swing trade, but generally speaking, most people don't. So one of the points, obviously, is judging your entry points. And it works the same in non-volatile times as volatile times, but you just have to judge them a little bit better. You have to be a little bit more patient for them to really crystallize before you open it. So less pending orders and more manual approaches. All right, so if we go to a chart, and right here I have, why is this chat window in my way? I know, Hassan, that's what I said, that Hassan mentioned, like, sometimes you hold on to a bad trade and it just keeps betting and worse. Yeah, this is what we call marrying your position. Taking a loss is part of trading, and it's better to do it early than do it late, but not in the sense that you're constantly closing trades when you think it's not developing. There's a fine line, and this takes a little bit of experience. There are some rules that you can put in place, but generally speaking, it's just experience how to do this. But when you have a trade that is hovering between your entry and your stop loss, and it just stays there, and it starts going down to your stop loss, the biggest mistake beginners take is start moving that stop loss, because I know this trade is going to turn. I know it. Everything yells, I know it's going to turn. So I'm just going to give it a little bit more room, a little bit more. All right, 600 pips later, you're still moving that stop loss and you're still not there. And for the one time that it does indeed turn with that little bit more, the problem is it gives you that false confidence. Like, see, usually I should do this. Yeah, but you forgot you already lost 20 trades before this doing that, and now you won one. That one that you did win is not covering the losses of the 20 ones that you lost before that. So for the terms of consistency, what we traders should be looking for, right? You want to trade consistently profitable over a year. You need to go always on the approach of what is the most consistent result I can generate with my trading. And moving your stop loss and stuff like that is not, because apart from the fact that you're screwing with the whole risk reward ratio system and your whole risk level on your capital, that's a whole bunch of other apples, you're just setting yourself up for false confidence and completely screwing yourself over. So good one, Hassan. That's a very common one. But I'm pretty sure more of that's going to come up in the Q&A. So let's talk about entry points for a second, right? All right, so I got a blank chart here, and I'm just looking at a day. Usually I started a week just to get a good idea of where did we come from, where are we going, or where were we going, depend. Now, this is oil. Let me take a currency, because for entry points on oil, let me just put it this way. Oil will eventually go back to about $86 a barrel. Right now, don't know. That depends on if they speed up production, and other contracts that are going to be closed between OPEC and everything else, and OPEC. It's a little bit too complicated to get into now. But if your account is less than $10,000, you should not be trading oil CFDs now, period. Step one, just forget about it. It looks like a great opportunity. I can make big sells and big buys. Yes, but your account, your risk that you have to take these trades is not smart, right? Because you'll be well over 5 to 10% of your account per trade if you set it up correctly. So the answer is just you let it go. You forget they even exist. You still track them from time to time, but you don't trade them. So here we have the euro US dollar. And like I said, I started a week and, we knew the whole COVID drop in March 2020, that recovered pretty fast by May, August. And then since then, it's right what we can see. It literally just went back to wherever the hell it came from, and it started climbing back to 2018 levels. And it kind of like leveled out there for a little bit, dropped, and now we see that okay. So then it started dropping, and now with obviously the whole sanctions really coming through and everything else, this is roughly where the war started. And then the sanctions came, like, okay, bad decision, good decision. Okay, now we see the effect of what those sanctions do for the euro and for the dollar. The dollar is obviously in a much stronger position than the Europeans. Right? First of all, they have their own oil supply to start with. We don't. So that's going to affect us. And furthermore, the US has a much stronger internal economy than most of Europe. And I say most of Europe. And that's because Northern Europe and Britain have a stronger economy than Southern Europe. Right? Think Portugal, Spain, Italy, Greece. Right? They rely on tourism and they've been hammered. Up north, we have trades, we do import and export, we have a lot of raw materials. You don't have that in the south. Right? So the euro is, because of that definition, already in a weaker position than the dollar for quite a bit now. Now, obviously, this whole climb was after March. That was when the US wasn't deciding on what to do. And then that's why it leveled out. So we now can start developing, okay, went down. Has the market reacted to the war for the Russia-Ukraine? Because that's the main reason everything is moving right now. How has the reaction been? Well, overall, the US is weaker than it was before, but stronger than the euro because the euro is in an even worse spot. Okay, that's all I needed to know from a fundamental point of view. So what does that mean for me? Well, let's just draw up a few basic key levels first, right? So that needs to be thick. Okay. So what I usually do is, first of all, I look at what's relative. A lot of people are going to do this. Well, this is the high point. Or on a week chart. Going back there is going to take months, if not years, right? Depending on how well the market recovers. This could literally take a year and a half. So there's no point putting this line there anywhere. This is the previous high. That might be 3 or 4 weeks. That might be a good one to keep in mind. Hold on, I just need to keep moving the chat because it's like right in my window. And when I cross that line, I see a connection point here. Oop, and I can make it clean, right? I can just do this. Right, and remember, we're looking at a technical point, even though we want to look at fundamentals as well, right? More than ever. But you still judge your entry points based on your fundamental analysis. Now, if we look at the previous low, it'll be here. That is the March outburst of COVID. Now, that was an exceptional situation. And normally, I would tell you, you ignore exceptional situations, right? Like COVID spikes, because they need a specific market situation to occur in order for it to make those weird movements. But we are in that market right now. So this could be the more relevant market level at this point. And you can consider yourself a range. You just take a range from the previous low to that. And you can use the wick if you want. Generally speaking, I do my lines with this because I want all the static away. I just want clean lines. That's up to you. A whole topic on that. So I just consider this a range. Anything in this range is critical level, because if it drops under that, then we'll start looking at levels even further, right? And this is for a week. You don't need to do a whole bunch of analysis on a week. You could say, okay, I can make a trend line, but really, why? Like, you know it's going down. What are you trying to judge? Right? You can do this better in a smaller time frame where your actual entry point, is. It's okay to keep it in mind. Like you could do just the top line because we know that it's selling. We know that eventually it will turn back around, but right now we're not looking for the turnaround trade. We're not trying to swing trade. We would prefer to take selling trades. So we want it to get anywhere near that line. But waiting 2 weeks for it to climb back and then turn, are there better opportunities? Well, yeah, in a smaller time frame, there are more opportunities. So now you go fine tune. So you know these critical lines. Whenever it's up here, for sure you're not buying. And if you have a buy, this is where you consider start closing it, right? So you can already judge just by this where potential entry points are. This would be perfect entry point, right in that circle. So insert object. Work with me. There we go. So anywhere in this region, underneath the line, let's say. Can I make this? Yeah, there you go. So anywhere in this region would be an ideal entry point. Are we going to get that ideal entry point? No. Now, some of you are going to say, then why not just take the buy? Remember, we're still in a day chart. So if I want to take the buy now, the correct stop loss would be where? Underneath the previous? Actually, let's do that because this helps you with entry points. No, we'll keep them red because it's a stop loss. All right, so 1, number 2, or number 3. What would be the correct stop loss if you would take a buy right now to go up here to trade the pullback or the rally, I should say? Number 1, number 2, and number 3. Who's going with 1? Who's going with 2? Who's going with 3? Two, 2. Everybody's going 2. Everybody wants 2, huh? Okay. So nobody's saying 1. Thank God for that one. All right. Now go to your own trades and check how many times you actually take number 1 instead. Are you still confident about number 2? Most of you are. Interesting. I wouldn't be. Because I want my stop loss to be in a position where we'll only hit it if there's an exceptional situation where it reaches it. I don't want it to hit it just because it felt like wicking a little bit. So this is your understanding of, this is where the optimal, where the ideal stop, it's actually slightly lower because of that little wick, but this is the ideal situation for your stop loss. Now you know that if I would market execute a buy, that stop loss is 360 pips. I know some of you are going to go like, holy crap, that's a big. We're in a day chart, so remember that. Also, that's only 36 bucks. It's not that big. On a micro lot, obviously. Now, here's where that whole calculation thing comes in. If you would take the buy, let's say you're adamant about buying the pullback, buying the rally, and then closing it here and then taking the sell. So you want to do both directions, right? Let's take that scenario. Your stop loss, your take profit would obviously be somewhere in the judged entry point, because you know that once you start getting here over this point, there's going to be a bunch of pending orders anywhere up to this level. So the volume is going to start increasing for sell. And people that have buys are going to start seeing it slow down and start getting skittish and start closing it, flipping the selling from you even more to buy. You guys ever think about that when judging your take profit? Who actually considers that there might be pending orders, and thus that's creating the volume changes and stuff like that? Because not many people do, from my experience. And this is why you have like these fixed price points where you always see MUPs change. They're usually round price points. Yeah. They're usually round figures. Now let's see what figure we're at. This is the 140, the 114. Is this 114 exactly? I don't think so. Yeah, 114.3. So anywhere between 114 and 114.6, you're going to start seeing a lot of pending orders being hit because a lot of people are going to have selling position pending orders here because it'll be high. Now this, if it follows the average curve, which is that one, I think I actually judged this just right. This one was a lot slower. It was more horizontal than anything. So we only had, hey, come here. Stop it. Right, so roughly this is generally the angle. So actually this was a pretty good guess. All right, so by angle, I mean. So now you can judge if I would enter now, my take profit would be 440 pips and it would be 9 bars. So that's 9 days. So it's about a week and a half of trading, right? You have to go over the weekend and you hope that you know, nobody blows something up with a nuke that makes the market jump on Monday. Although that would be a little of my concerns, but still. Right. Anything crazy happens in the weekend. The markets, just because the markets charts are closed, doesn't mean the markets aren't being reevaluated on Monday morning before they open. The weekend, the charts don't move, but money still moves. So the money still gets different valuation. The chart technically moves without it moving. That's why you get gap openings. All right, so if I would go in here, we've already established that this entry point where I am right now, we want the stop loss either here or here. So even if we take stop loss number 2, which is more risky because you are in a situation where it can normally go, and we're in an exceptional market, in a downtrend, right? On the week we've seen, we're in a downtrend, more strong than we are in an uptrend. So you're taking basically against the trend. In a situation with the US, we know it's a little bit stronger than Euro because of Euro situation. You're still taking a buy and you're taking a stop loss inside the exceptional situation. So even then, you're still talking about a 250 pop stop loss to a 400 pip take profit, which is less than 1 to 2. And ideally, we want 1 to 3 on average, right? Which is not realistic. You're not always going to get that. Sometimes you get 1 to 1.5 as a decent trades, and sometimes you get 1 to 12, right? But it should balance out over all your trades, so about 1.3. Let's take, because everybody set number 2. Let's take number 2. Let's take the small stop loss. Now let's take a scenario. I'm just going to go off the average here. I'm going to say $1,000 account. Okay. And you have a 3% risk per trade on your account. What's the lot size I can take? Because your entry point judges that. I don't care anything about this. This I don't care about. This part, that's what I care about. I've never heard anybody complain about making more money. I have heard them complain about this part though. I mean, I'm the one that complains about this part. Losing money always sucks, but it's part of trading. So at least if I'm going to lose it, it's got to be lost because I actually did something wrong, not because I did something stupid. Right? So, and trust me, I did a lot of stupid stuff. So don't beat yourself up. So 250 pip stop loss, 3% risk on a $1,000 account. It's easy math, right? I always get people with this. I love it. What's the lot size I can take on this 250 pip stop loss? We have a $1,000 account, and I would take 3% risk. Anybody? Okay, so okay, we got $30. We got 0.2, so that's 2 mini lots. We got 0.03, which is 3 microlots. We got 0.3, which is 3 microlots. Okay, let's do the math, guys. 250 pip stop loss at 3 microlots, it's 30 cents per pip. That would make it a $75 stop loss. If my 3% risk is $30, I'm slightly over that limit. Just saying. This happens to be a 0.01 trade. Because you're late for the boat, because if your entry point would have been here, and there's not many of you that are going to take that risk, but let's just say you decided to buy anyway. Here, that becomes a whole different scenario. Oh wait, hold on, let me put both of them in and make that one green. So you can understand how big of a difference that really matters with entry points. So this is why you have to be extremely careful with your entry points and the direction you're trading. So for this trade is 0.01. That would make this a $25 stop loss, which is acceptable, which is within the 3% range. It's 2.5 actually, so that's fine. Okay, that's 2.5% risk for one single position. That's fine. I can take 10 of these. I'll risk 25% of my account at any given time. I'll still have 75% of capital left to play with. That's a balanced account, right? You can do a lot with 10 trades for a portfolio. Now people go like, oh shit, never thought about that. Now this one, let's say you went in a little bit earlier. Now this is really hard to do, especially when you have like this big decline and then you get the pullback, and then I know, but hear me out. Oh, I see. Yeah, okay. I don't know what happened there. Sorry about that technical issue. For some reason my headset turned off. Can everybody hear me again? I think I caught it right as it happened. So, all right, good. So everybody heard the part about this explanation, right? The 0.1 lot size one. The $25 would be 2.5%. Yes, perfect. All right. Thank you, everyone. I love it when audiences play along. Thanks. Right. So now we're getting to this one. Now, apart from the fact like this is on a day chart, we're going to go to a smaller time frame later because you don't do entries on day charts. You do it on smaller time frames. No smaller than an hour, but that's another story, which we'll get to next. So if you would go in around this level, your stop loss would now be 140 pips. This stop loss doesn't change position. This tells you where the stop loss goes. Your technicals tell you where the stop loss goes. That doesn't change, not even in a fundamental market. You're judging it by levels. But this entry point just made it a completely different ballgame, right? So this is 140 pips. So let's do the same thing again. 3% risk on a $1,000 account. So my risk is $30. Those don't do math tonight. What is the lot size I can take on this trade? Yeah, that's pretty obvious. 0.02, yeah. Right, 20 cents per pip. If you take, by the way, if you take it on 0.1, that would make it $1 per pip. That would make this stop loss $140. If your level is $30, you're slightly over. Also, you're basically risking 10% of the account in a single trade with a suboptimal stop loss. I'm just saying. All right, so 0.02. So what does that mean? You might think, oh, it's only 1 microlot more. That doesn't matter much. No, fair enough. You're still risking the same $30. We're both risking $30 on the same levels, right? but this take profit also doesn't change. So from this one, your entry is now a take profit of 460 pips. So you're risking 30. Hey, hold on. You're risking 30 to make 46, which is like 1 to 1.5-ish. And here comes the kicker. Here, I'm risking 30 as well. But I make 560 pips, which in the other one would be $56, sorry. But we're trading at 0.02, so it's actually 112. That is a big difference. This time lapse, this difference in entry point is a difference between $50 take profit with $30 risk and $30 risk to $112 profit. This is why I stress judging your entry points and being patient. You're risking the same with both, but you're making a significant amount more when you judge it right. This takes practice, a lot of it. It's not as easy as it sounds. But let's go to an hour and let's see if there's a pattern in which we can recognize how these entry points come to be. If you trade on 4 hours, do 4 hours, it's fine. You have the similar rules. You can use price action, etc. But an hour gives you a little bit more on that time frame. So we're looking at this line. So here at the bottom, where we were, where can we see? At what point can we see? We look at this line where it starts. That's nowhere near the bottom, right? So we'll take a snare. I keep having to move the chat box. So if you think, why is he moving his cursor so weird? It's the chat box that keeps playing in my window. I'll put it up here. Okay, so we come down, we hit that bottom. That seems to correlate with the previous bottom that we saw before, right? Over here, right? This whole thing. So that's where, this line that we had on the weekly, if we do it now on the daily and zoom out all the way, then we could probably find it somewhere in here. But you don't need to put an hourly resistance if you have a weekly resistance there, because week overrules the lower time frames. Makes sense, right? Bigger overrules small. So you come here. Are you going to go in on this trade when you have a morning start? No. All right, crows, no. This is price action for those that do that. Okay, we still wait. Not really any signal here. Nothing here. Okay, we got our first spike, pull back, spike. Now you get a pullback again, and then you see green again. Now, when we've had this whole set already, from here, you have 1, 2, and 3 bottoms. Right, so you can see that it's leveling out around this level with this exceptional spike. Right, this going further. Don't delete everything. Good. Now we can say, well, hold on. We had a higher low, and that's been consistent. And if I take the wicks into account and go all the way here to the first spike in green, and I pull it all the way through, I extrapolate it. This doesn't exist for me right now, right? None of this. I do need to learn how to draw straighter lines though. There we go. So this is the information I have that allows me to establish this line based on this point, this whole package, and this point. Is everybody with me on this one? Well, how I got this line. Let's say the market's somewhere over here, doesn't matter. We then see this market drop, hit this line, stop it, and the next hour it starts to go up. Now this is where you might want to pull the trigger. Now if you're a little bit more experienced, you will probably pull the trigger because it's like the third time it hits the connection point. It didn't drop through on the next candle. You might want to wait for this candle to close. But the second that it closes, you see this candle going up, you just grab it. So your entry point would probably be somewhere over there. Now let's say you were too scared and you waited for it to go all the way up. And then you see it pull back down. When you start seeing it level out again, right, you have this curve. You have this wick that pulls back in. You know that it almost hit that point. You could have gone in anyway here. So let's say anyway here. You had literally 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 hours to do it. So don't worry and being stressed about, oh my God, it's not at the lowest point. You have literally 10 hours to make your decision. That's more than your working day. So if you see this in the morning and you come back from work, it'll still be there. Like people have like this FOMO, like, oh, I'm going to miss the trade. Yes, sometimes you miss the trade when it does something like this, but then like all the way up to here. Okay, but you're not generally aiming to trade those trades because they are not consistent. It's nice if you happen to grab a buy and it does that. That's cool, but it's not what you're aiming for. This is greed. This is like big eyes, right? You aim for what is consistent. This is consistent, right? So anywhere along this whole entry of judgment, you could have made that decision because you have this line to go with. Now, what does that mean for the stop loss? Absolutely nothing. The stop loss is still judged here. Because you know that even if it goes back down here, you already know where your take profit's going to be. It's going to be there. Now you might think, well, that's a very long trade. Okay, fair enough. You want to trade short? Let's trade short. Stop loss is still going to be there. Where's your take profit going to be then? Let's say, okay, well, fair enough. All right, Mike, we're going to do this. Right, so I factor in these wicks. That means that the stop loss is going to be here. Sure, it's riskier than the trade that I set up. It's not impossible. It's not terrible, but it's riskier. If we go to a day trade, just under the previous wick. If it does one little pullback and does a little bit longer wick, you're screwed. But let's say for an hour trade, okay, all right, fine. Then this is my entry, right? You're a little bit later, right? Where's your take profit going to be? Are you still going to put take profit all the way up here? Well, if that's the case, then why don't you just put the stop loss where it belongs? If you're going to go like, okay, well, I'll just do this. I'll measure, what is this? That's 100, so I'll do 200 up. There. So there. In this case, you would have actually hit it with a lucky strike, but do you understand that this is not a smart way of trading? This is not calculated. This is guessing. On what basis do you judge this? Can you guys see? I'm just you guys see my trading view, right? You see my MT5? Somebody just said they didn't. I just want to confirm. Yeah, everybody can see it. Okay. It seems to be something on your side, buddy. Try just closing it and restarting it. Maybe that works. All right. So, right. So you understand that if you're going to trade this trade, then just trade the trade. Now, how can you make that into a shorter trade? Right? What system can I implement? So this is entry point number one. The ideal one is judging entry point up here. Well, that's a week. Right? That is the more consistent one because it's more likely to go back down once it gets up here, depending on how the market is developing. And this is why tracking the fundamental development is important, because once you get here, you reassess the entire market and you wait. We know this is the good area for a sell, unless the candlestick closes above these lines, because then we know it's not. It might pull back in, sure. but you don't put a pending order there because we are in an exceptionally low. And if the market over the next few days develops in favor of the euro and against the dollar, for whatever reason, then this entire chart flips upside down and goes back up. So you wait till you get there, then reassess the market, rejudge your entry point where you are now, like we just did here, but you do it the other way around. Because if your entry point is here, it's obvious that your stop loss is simply going to be there. Right? Because the only reason it to go there, it needs to break the trend, and it needs to break the resistance from the previous two highs. It needs to break 2 points of interest to get there. So now you have an entry point like here, and then you can just ride the wave. You can say anything you want. You can do take profit 1, 2, or 3, or 4. This is entirely up to yourself. Generally speaking, I would say you go like something like this. You take almost the entire channel. Right, but that's again case by case. It depends on how the market is developing back then. Maybe it's settled down a little bit, maybe not. Okay, so that's entry point. I hope that made a little bit of sense, because there's a lot of different scenarios, but unfortunately we don't have the time to go through over like 20 different scenarios for entry point alone. I did a whole webinar on what entry points, just watch that. So the next one I want to do is, like I mentioned, you calculate your 3%, you can do 10 trades of that, you still have 70% of your account available, right? And you have 10 open trades. You need to make your money work. What's the point of having a $2,000 account if you're going to do one trade at a time with a $50 stop loss? Then why didn't you just put $200 in? The whole point of putting capital into a trading account is to use the capital to set up a trading portfolio. It's not a buffer so that you have that much money that you can lose. That's not how this works. It's a capital that allows you to create positions and develop a portfolio of trades. Well, I did the same at the start. 1 or 2 trades, follow that. I don't want to risk too much, but if I lose something, I still have this much left. That was my mindset, which I really realized is dumb, because you use capital to trade, right? So use your capital. But when you set up a portfolio of trades, you might want to reconsider that you're not putting too much exposure on something. You have no idea how often I see people will come to me. It's like, hey, these are my trading analysis, and I see they're all euro based. Well, yeah, I trade mainly euros dollar, and then pound dollar, pound CAD, euro CAD, pound yen, and US dollar JPY. It's like, wow, great, that's 5 different currencies. What diversification we have here. That you're overexposed. Like literally, you got one Asian market, you got the middle, and you got the West. You're spread out globally speaking, but over 5 different things. So you can have 3 trades at any given time, because otherwise you overexpose your account to any single currency. Generally speaking, I say if you have 10 trades, you take no more than 2 of a single currency. And there's so many options within that pair, right? Euro, you have a bunch. Pick the best 2. Right? Based on this entry point. So which direction is the trend going? Is one of them to happen to be at the top or bottom of the channel in direction of the trend? Then that is your most consistently profitable, logically profitable trade. Right? Like, think about it this way. How often do you open a trade in the bottom of a channel that's a sell, and you take the buy and it doesn't work out your way? Because it doesn't quite develop right, or just kind of keeps stalling, or it has like this fake out, and then it does what you think it does. And how often do you take the trade in direction of the trend? And I'm not saying trend is your friend. That's a dumb saying, because you need to understand how a trend is. But don't, by the way, I'm saying these things like dumb. That's me. That was me 12 years ago, and I went through that. So I call myself that. Down and up, right? Go through your history, and you will find when your entry point judgments are. And a lot of times people tend to try and beat the market instead of just go with it, because you think, it's down now, buy low. I'm going to buy, and it's going to go all the way up here, somewhere in the stars. And then it develops like, a third of the way, and then it just flips around and just screws your whole day up. I'm sure that sounds familiar for some of you. Right? So do the smart thing. Just go with the flow. Don't try to beat it. Right? And control your exposure. So if you have 10 trades, no more than 2 of any single currency. And if you have dollar in it, obviously, if you have a bigger account and you're also trading commodities, don't have oil, gold, and 2 trades on dollar. I'll get back to that in a minute, Jack. Now, one of the things that's usually people yell at me for, trailing stops. And I try to explain, because we can go in a long discussion why it's better not to use them and to use manual manipulation of movements. The realistic day is, first of all, if you trade with a phone or a tablet while you're at work, you should delete the app from your phone because it's a terrible habit. 2, that proves my point. You're at work. You're not in front of a computer. You're not a professional trader or a day trader in the sense of that's all you do. If you're working from home and you have to chart all day, that's a different story. But still, you're doing something else. So you're not just staring at 6 screens at the same time, just waiting for things to happen and then judge by that. So a trailing stop is a good alternative method to at least make sure that once your trade, if you're using MT5, goes to a certain point in the profit, it automatically moves your stop loss to 0 and then moves with it. The worst thing that you can have happen to you from a mentality point of view, as well as just for your accountant's consistency, is a trade that is green end up in red. It feels terrible. Not only that, people go like, yeah, but then it goes out at 0. Okay. All right. So let's do 10 trades. We all put them up with trailing stop. And after these 10 trades, 5 of them went to take profit and 4 of them went back to 0. Well, let's say 2 of them went back to 0 and 3 of them you lost. The 2 that you put out at 0 cost you some time, but they didn't cost you money. So you're already improved your, the decline of your account. No, not decline. You improve the downside of your account, right? It's that simple. Losing time is okay. Losing money isn't. Like time we have some to spare, relatively speaking. But your account has a certain number and you're trying to grow that. And it's not going to grow if you keep taking losses where you could have gone out at 0 and just negate the entire trade and just be like, well, shit, try again later. Right, that makes sense? Resist the temptation is another one that I really wanted to stress on. This is the one that I just explained. We now did the entry point for the buy, but this is the temptation that I mean. Like, even though we know that it will probably rally back to the top, you know it's in a downtrend. You know that it's the more risky trade because you know that there could be an announcement in the next 20 minutes and it just dumpsters the euro. Could happen for the dollar as well. Yeah, but like I said, the dollar has a stronger internal economy and they profit from war. Europe doesn't. Well, not as much. So you have to resist yourself from like trying to make swing trades happen because you think, well, it's so low, it's probably going to buy now. Well, then just wait for it to buy, establish a confirmed buying trend, and then ride the way back all the way to the previous price point when it reestablishes itself. You'll have plenty of buying opportunities, but for now, just take the selling opportunities when they present themselves. So be patient. There are so many pairs. You can find one. And again, if you have a smaller account, so anything under 2 grand, so 2,000 and less, I would recommend sticking to majors and minors. Don't do exotics. Again, you need to understand that exotics all have different lot size calculations. For instance, the US dollar, Turkish lira, right? It's the same as oil and gold, mini lots of micro lot. So it's 10 times less than what it should be. Like, and this is different per exotic pair. Like this takes a little practice to learn, or you have to look it up, and then you're just making it difficult for yourself. If you're, especially when you're starting trading, I understand that there's a lot of profit to be made in the more exotic stuff and in the bigger volatility stuff and you know, commodities and oils and CFDs and stocks. I get that. But learn how to crawl before you walk, before you start running. Don't try to go from I just got born to let me just run a marathon. This is not going to work out for you. Take the time. It's a long period of time kind of game. Right? So don't try to beat the system. Right? You're not smarter than the market. If you do honestly think that you are smarter than the market, you've already lost. Unfortunately, it's also one of the very few things veteran traders can agree on. But yeah, we all have that mindset. Don't try to beat the system. Understand who you're up against in the first place. We're a bunch of retail traders. Like all our wealth combined is half of what they're throwing in there. And I mean globally. We're not going to do anything. What's your $2,000 account going to do in a $6 trillion market? It's not going to cause any ripple. So don't try to beat the system. Just go with the flow. Just be smart. Okay. Obviously, a few other pointers that I just want to make out is make sure that you set, if you have moving averages like indicators and stuff and stochastic and RSIs, make sure you set them a little bit tighter during volatile times so they don't jump completely out of ranges. You just screw up the tightness a little bit, right? So make them less sensitive to jump, so they give you a little bit more accurate reading. And the trailing stop really is a thing. I'll just put that on before we go to the Q&A, because I know I'm gonna get this in the Q&A. So let's go back to this story. So how would you set up a trailing stop on this? This is basically usually the question, right? So let's say you have this trade. We had something like this. Okay, now there's two things you can do. First of all, look at the rally. Right, the last time it went up, this is kind of when it up, and look at the candles down in that period. Right, this will give you an idea of how it generally tends to pull back in upward movement. So you just, you calculate them. Okay, that's 60, 40. This is you do this on a day, by the way. 50, you can do it on less, but I would recommend just doing it a day because you wanted to get the average daily rate. So if you ever see ADR, that's what they mean, average daily rate. 60, 50, 60, 70, that's 80, it's a bit bigger. That's 40. That's never 20. No, that's 40, 40, 80, 40, 40, 60. So a bunch of 40s, 280s, and a 60. So let's say an average of 50, 55. Right, that's roughly the average daily rate when it's pulling back. Now, is this one already longer? Probably. This one's probably 50. This is already 100 pips, actually. Why would that be a lot bigger than the previous times? Well, first of all, it hasn't established its way up. And second of all, you just had a massive jump. So it's pulling back 50% of that candle. Right, so we can just look at it this way. Right, so here up, we have pullback. So now you can do it in an hour if you want, but we know on a day, it's roughly 80. Because this could be going all the way back down. And we went in here, remember? And our take profit was over here. So let's say that's your trade. And Well, yeah, let's just go with that. Because otherwise we're going to complicate things too much right now. So we know it's around 60. So what you do is you have this trade. Oh, now I need to open the trade, right? Yeah. Okay. So let's say you have this trade open. Just imagine this is here, okay? I can't open it here. Well, I could do a pending order, I guess, but whatever. So we know our stop loss, but we don't care. What we do care about is the average daily rate. So we know that the average daily rate downwards in an uptrend is roughly 55, right? So take a little bit more than that. So we saw some 70s, so let's go with 65 pips. I think that's pretty fair. There were only 2 scenarios where it beat that. So you really just right click, trailing stop, custom, 700 points. This last number is a micro pip. So 700 points is 70 pips. And you press OK. Now what happens is, let's see if it would have triggered it. Follow me. We're in. 20, 30, 40, 50, 70. Your trailing stop would have gone to 0 here. You already negated $30 risk. You are now secured. So at this candle, if I judged it right, yeah, right this candle actually, you would have had the stop loss move to 0. You can now no longer lose money. That already feels good. No matter what happens, at least you won't lose any more money on this trade. And now you go up. So eventually you go up all the way to here, and from there it pulls back. Let's say if it pulls back 70. It does. Perfect example, yes. 65 and a half. No, it would have actually just missed it. Shit. Okay, let's say it did hit it. Because it would have gone there and then pulled back. It doesn't matter. Well, actually it doesn't. Yeah, let's just do here then. Right, whatever. It went here, this is the highest point, and then it pulled back 70 exactly. There. So this would have moved all the way up to here. Did I judge that right? A bit more. So bottom of that one. Okay. So there. So this little trade that we took earlier at 0.02 still made you 30 bucks. 1-to-1 ratio, not ideal for the risk we took, but it was a trade against the trend. And I still made profit. And I made profit in, well, depending on where you went in here. If you went in here, it took that long. If you went in here, but let's say you went in somewhere in here, it would have gone out on this candle. So it would have taken you 32 hours. Within 48 hours. There you go, guys. Not too bad. It's 3% increase in the account. If you have a $1,000 account. You do 10 of those trades, your account's up 30%. And this is going out at a sub-ideal level because it pulled back a little bit more than it should. You understand now why it's not a bad thing to do trailing stops? So this is like that sticky note thing that I said, right? So you judge your entry. Did you calculate your lot size? Did you double check your fundamentals? Yes. Okay. Pull the trigger. Yes. Go. All right. Set up trailing stop, calculate ADR, and then set it up. This is like a few very basic things. And then you do the micromanagement. So then you get I follow the news, I make sure everything's there. But this is why I say trailing stop, because it's not realistic for me to tell you guys like, okay, follow the news, look at what the big investors are doing, then micromanage your trades and double down or de-size or increase lot size on the existing trade. Like these kind of steps, even though I don't think Legacy FX even allows you to change the lot size during trade, but like these extra steps, like they come way later. This basics alone will help a lot of people in volatility get out of, keep losing trades, keep having trades go green. I'm 50 pips up, I'm 30, 100 pips up. And then, you come back the next morning. Yeah, I was sleeping last night. I woke up this morning. Shit, it counts. I lost the trade. How did it hit my stop loss? Well, if you would have had a trailing stop, it wouldn't. And you would just woken up, hey, you got a little richer today. Not as much as you wanted to, but you still got some money. That feels a lot better with your morning coffee than, well, I guess I lost money even though I was winning. Right? So that's kind of where I was going. I hope that makes sense. Right. So for those that are watching the recording, sorry for a few technical issues and stuff like that, but I hope you enjoyed the webinar and I hope this helped a little bit. So yeah, make sure to thumbs up on the Legacy FX and subscribe and all that kind of fun stuff. All right. Thank you. And for those that are in the actual webinar, now we get to the fun part. For those that are leaving, that are not going to stay for the Q&A, there is usually a survey sent out at the end of the webinar once we close it. It's up to you to fill it in. Obviously, it's anonymous, but it helps you. I mean, there's a rating obviously for me and the content. You know, if you thought it was shit, it's shit. If you thought it was good, it's good. But it also allows you to give feedback on topics you would like to see, questions you may have, you know, just general feedback and suggestions. And that really helps Legacy FX out, you know, to tell me, it's like, hey, people want to see this, and you know, you're all customers of Legacy FX, so right, then I can make more content for you guys based on what you want to see. All right, yeah, as long as more people get the same request, then we just make a webinar for it. All right, so yeah, for everybody that is leaving, thank you for your time, and hope you learned something, and have a great day, evening, whatever it may be. Now I'm gonna have a sip of a drink, and I'm going to let you fire away on questions. The way this is going to work, I'm just going to read it out. I'm going to read out the question, and then I'm going to answer it, so that people, you know, so we're not answering 16 times different the same question. All right, Sashi, can you please guide us more on trend reversal? Oh, you mean in the next webinar? Okay, put that in the survey, Sashi. Trend reversals is a tricky one because I generally avoid it for beginners because it makes them go into the mistake of trying to do trend trading, swing trading. But please put it in the survey, because if a lot of people want to know how to start judging when a trend is actually reverted or changed, then because it's a little bit of a trick between Fibonacci retracement and price action and critical levels. Well, I already gave the answer basically, but it's plotting all that out and then waiting for an actual confirmation and then cross-referencing that with historical turning points. There's a pattern basically for every pair. So it might take a little while to learn it, but yeah. I hope that answers that question. Hey Vanu, hi Mike. You mentioned that in volatile times, tighten up your indicators, i.e. stochastic, moving average, etc. I've been using stochastic settings of 1433. Is this still okay, or tighten it further? Let me just set it up real fast, and it depends. What time frame do you generally trade on? Because you should have slightly different settings on. Four hours. Okay, yeah. So okay. So basically, the way that you judge this, and it depends a little bit on your strategy. So there's a lot of obviously interpretation here. But let's just insert the indicator. I don't know what the standard one is here, or how it's set up right here. You mentioned stochastic. All right. So let's do an oscillator stochastic. So the normal, right, is 1426. Yeah, close is fine. This, I generally have it now set to smooth, because you wanna slow down the curve, right? You don't want it to grab every little hick and cranny. You want to basically just smooth out the curve a little bit more while it's volatile. You change that back to the normal linear weighted, unless you have a very specific way of doing it. Like let's say you are using a simple one. Simple is more stable, but can sometimes miss signals. Exponential picks up on more signals, but can give you false signals. Smooth is kind of like the middle ground between the two, and linear weight is just a more stable what normal market sense is. But it depends again on your strategy, what your general idea is. But I'm just going to approach, let's say we go in blank. So our levels, okay, what do I have set up? 19, 10, 50. Okay, so I've done that before. The scaling doesn't matter. That's up to you, whatever. So let's, what did you say? You have it at 14.33. Wait, why is your D period the same as your slowing period? No, because how percentage K and how percentage D work, this should be half minus 1. So if I put 20 here, this should be 9. 10 minus 1. It's the algorithm. I can look it up. Yeah, but this should always be, like the slowing is just how much you delay the signal, right? So if I do 6, it just shifts. Why can't I type in 6, right? So here, right? So 14.6 is a stable thing. So here, now let's look at the curve. Because okay, all right, here, properties. Wait, what? No, indicator. Thank you. So you had, what did you say? 3. All right. You saw what happens? Your trigger line shifts really close to your signal line, which means you're going to get signals all the time. Like it'll nip the signal line all the time, really early. You want to slow that down a little bit. You don't want to have the signal at the perfect moment. You want to, when it's actually established. Now, this is why I say it depends on your strategy, because if you're a scalper, which you shouldn't be, right? Whoops, sorry, the other way around. You would put this to 1. Well, almost. It was probably 2, I think. Yeah. But yeah, you're also trading like this then. But you want every single time it goes through, I go in, I go out, 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 I go in, I go. Jesus Christ, makes me tired just doing that. Go in and out for 5 pips. Screw. No, thanks. I'm good. I want to slow it down by 4. In this case, I want to slow it down by 4. I want to take, like, this is the thing. If you have a pair that has a lot of wicks and little body, you set it up for low high. So you have a pair that has candles with a lot of different wicks. Low high, because then you want to calculate in those wicks more often. But generally speaking, like here, you don't have big wicks, you have big bodies. So you want to take the actual closing prices. You want to just take the median line. I hope that makes sense. So here we have, okay, so here is, right, here's your signal. Go in for a sell, close your sell. In this case, you would have basically not gotten anything. So you go in for a sell because this is your selling signal again. Or am I doing it the other way around? No, it's okay. Right, sell, and this is where your sell would go out. So you would go in here, go in here. So in this particular scenario that I just grabbed, these signals, if you do it blindly on the stochastic, you wouldn't have lost anything. We wouldn't have gained anything either. Now we go look at here, right? Signal line goes up, and we can see here that it's staying on the top a little bit too long, right? So what happens if you increase the K? You shift it. So you should, right? Should I go lower or more? Should I increase the K time or decrease it based on the shift you just saw? Increase, exactly. So we saw 16 maybe, but so let's go for 20 and 9. That's a little bit more like this. Right, so here we now get the signal to sell. Right, signal line goes through the signal line goes through the trend line. And it would have told me to close it here. Oh, well, you have this massive spike, so you would have probably been smart enough to close it there. But now we can see, okay, maybe we're slowing it down a little bit too much. What do we got if we do this? Now my signal would be here. Actually, in this candle just before it, because I probably need to. So this is maybe slowing down a little bit too much. So I actually think you nailed it. It's 3 in this case. Oh, perfect. There you go. Because that would be the signal. Now, if I fine tune that, I go to 30 minutes. That is where it happened. It happened just before the big spike. This was a news announcement. So that's where it happened. Right? So you would have gone in here, you would have went all the way up here, and you would have exited on this. Now, apart from just doing it blindly on the stochastic, having this massive drop and the median line not follow. Did I put it in here? Yeah, I did. Like this gap, you know that this is going to pull back and give you the closing signal, and you already had 2 candles that did not do anything. The third candle now closes, so the second this candle opens, this is an hour-long candle, right? This candle closes, you had 3 hours of the trade not developing at all. More often, it's 2 against your 1. So clearly, selling pressure is a little bit over. And then you can also, because it started here, cross-reference that with FIBO. Well, yeah, it's the 38 line. Yeah, so that makes sense why it stopped there. People have pending orders. Right, it did the pullback of 32.8. So that cross-reference with this, your signal to close. So in this case, I have it set up for 29. But for a day, well, actually, it's not bad for a day. So this would have been my buying signal. It's a bit late, but okay. It is a confirmed price action, Morningstar. So once this closes, so your opening is on this one. Not on this candle, on this candle. By the way, everybody's questions, I'm going to get to it. Please bear with me. So you would have gone in here. Now this is if you trade on these short time frames with stop losses underneath the previous low point, I generally avoid that, especially in volatile times, because you can get nipped by pullbacks and rallies, by pullbacks and rallies, right? So you want to wait for ideal entries instead. But if you have a little bit more of a Buffy account, you have already developed trades that give you a buffer, then go for these trades, that's fine. Right, you can take a few small trades in between. So here we would have the closing signal, so that would have been somewhere over here. Entry would have been here, so that would have been in here and would have been out somewhere here. Well, you still made a little bit, not much, but somewhere over here. You would have probably hit your take profit over here, actually. Because this one would have been set up entry here, stop loss there, take profit there, I think. Yeah, that's 13, 20. That's actually not that bad of a trade. 130 to 200. It's not terrible. It's not 1 to 2, but it's like it's fine. All right, so that's how you fiddle with it. You just try to get some previous entry points that you know, see how often the signal is correct, and then you have the right setting, and then you do it based on your entry point. So for 4 hours, here you would have at a close, here you would have a signal for buy, because signal line goes from down up through the median line, and it would told you to close it here. So for your 4-hour example, you would have gone in here, which kind of actually funny enough is exactly my example. And you would have gone out on this candle actually, so just before the drop. You would have had a pretty decent trade. You would have gone in on the next candle opening, and you would have gone on the closing, on the opening of this candle. Right, so you would have gone, what's that, 170 pips profit for whatever the stop loss you're in. All right, pretty easy. All right, so I hope that answers that question. You mentioned entering on 1 hour is better than on 4 hour bars. This is because of accuracy. For an example, a double bottom, breakout extra strategy, or reverse cup and handle. Okay, Richard. Cup and handle is also a thing, but you meant head and shoulders. Okay, fair enough. No, generally it is because I start my top-down analysis on a week, do a day, and then I skip 4 hours and do hour because a day will tell me the same as 4 hours does. But you can also do week, 4 hour, hour. But generally speaking, yes, I do execute on a 1 hour time frame because you get a little bit of a better sense of how the new volume is developing. Is it, one up, one down, one up, one down? So there's a lot of indecisiveness for the market. Do we just have the red is turning into a dead candle and a slightly bigger candle in a bigger candle, and then I have like, okay, so now we have like, and then you can judge price action a little bit better because that develops a little bit more in hourly. And then you have a little bit more this fine tuning, this accuracy, like you mentioned, for, okay, this is go. Like if you want to wait a little bit instead of just go in on the line. So yeah, basically accuracy. But you can do it on 4 hours as well. It depends on what you want. Personally, I prefer an hour for that. And then I micromanage my trades on 4 hour day. Like once it's open, I don't care about an hour. If you have, I hope that answers your question, Richard. Sabata, if you have an ascending trend line, well, hold on, the shift. Oh, there you go. If you have an ascending trend line acting as a support on a daily time frame, and then you switch to 1 hour time frame and you see the same daily trend line and the 1 hour time frame intercepts, how do you conclude to buy or sell? Well, Joanne, that's a quick one. The answer is no. If you have an ascending trend line acting as a support on daily time frame, okay, yeah, you mean the trend? Okay, yeah, okay, so an uptrend, right? Okay, I'm with you here now. And you switch to 1 hour time frame and then see the same daily trend line. How do you have a daily trend line on 1 hour? Oh no, yeah, sorry, I'm thinking week because I do top down from a week. It's a daily trend. Okay, so you see that one in the 1 hour, right? Yeah. And you see the same daily in the 1 hour time frame intercepts. How would you conclude to buy or sell? That's a good one. Now it depends on what time of day it is. Because if the market is at your daily trend line by the end of the market trading day, so basically when the US has only got a few hours left, the daily trend line is ruling because that's going to determine how the next day starts. When you are in the middle of the day, so the European market is still open and the US market is still open, you use the 1 hour one because you're using that to see where the market is moving. You're still many hours away from daily closure. And then you judge in how it developed there. You could, for safety in that case, wait for the trend, wait for the day to finish and see how the next day starts to make sure that it stays underneath both trend lines. More importantly, that it stays on the daily one, because the daily one would be the overruling one. But I hope that makes I hope it makes sense what I just said, Sabata. So it depends on what time of day it is. When using trailing stops, once the stop would make the trade profitable, do you recommend adding in up to maximum risk limit of, let's say, 1% per pair? Okay, Richard, this comes a little bit closer to not martingale, but it's more like what do you call it? Like martingale, but without scaling lot sizes. You can add an extra trade because that's basically what you're asking, right? Should I take an extra trade on top once it's secured? You can do that. if the trade is in direction of the trend and it happens early. So this is generally something that happens in bigger time frames. So when you have, let's say, a weekly trend, you're at the top of the trend, it's a downtrend. So you take the sell and it develops into a sell perfectly fine, which it does 9 out of 10 times. Well, let's be realistic, 7 out of 10 times. And it develops, right? When you get that automatic pullback, that small rally, now you get a little bit into the world of Fibonacci, but once you get that pullback to a certain level, that pullback, if it doesn't hit your trailing stop, yeah, that's another entry point to double down on your position to secure take the stop loss underneath the entry of the first one, at the entry of the first one, so at the same as your trailing stop is, with the take profit at the same level as the original trade. Then once that trade goes into trailing stop, it automatically already has the trailing stop of number 1 at the entry point of number 2, securing the entire profit gap between 1 and 2. And 2 gets secured automatically, so you can already lose money on that. And you rinse and repeat this process, and you can build this up. That's perfectly fine. That's a perfectly fine strategy. I use it. But you have to be careful not to be too judgy on it and do it too fast. I hope that answers that question, Richard. So yes, you can do it, but I would use the same percentage because otherwise you start screwing with your risk reward ratios. So you just take another trade, period. You calculate the lot size based on the stop loss. You do the whole same shebang again. And it could mean that it's a scaling, but your risk should be the same. You're not increasing your exposure because you've already secured the trade. So you're keeping your exposure the same. I mean, in amount of trades, your exposure increases, yes, but in risk level, your exposure doesn't increase because the first trade is already a 0 trade. So it's the same as not having a trade, if that makes sense. So you're just adding the same $1 to $30 risk again. In our example that we did, $1,000, 3%. Right, I hope that makes sense. So Joanne asked, what is the best time frame for scalping? Between sleeping and waking up. You shouldn't be scalping. Scalping is done on 1 minute and 5 minute. It's extremely intensive, and it's a very bad strategy when you don't know what you're doing. So scalping is like a thing that's been thrown around. True scalping, and I mean true scalping, the way it was originally made, not the way it's intended to be used, is basically supercomputers doing 7,000 trades in a single second. Now, I don't know how fast you can click, but I doubt it comes anywhere near that number. And you have to keep in mind, scalping is a candle is moving on a minute or 5 minutes. You go in and you have a 2 pip or 1.5 pip take profit. In, out, in, out, in, out, in, out, in, out, in, out. Guess what happens when you go in and it goes the other direction? You lose 15, 20 pips. So you negated 10 trades. So basically your win rate for scalping to be profitable needs to be above 95%. Or you're losing money. So that's why I advise people to just learn day trading, and I say that with apprentices here, with like quote marks. It is just more consistent, it's stable, it's easier to get a hold of. There are better strategies to trade with. Yes, I know that. Right? But I am always like being realistic on like what you think. Once you get to the point where you can start looking at advanced trading techniques, looking at swing trading, looking at ladder trading, looking at like combining different trading strategies within the same portfolio to diversify your approach even more. At that point, you wouldn't be listening at me anymore because you've already been trading for like 7-8 years and kind of know exactly what you're doing. Maybe not on those things specifically, but you already have a base foundation standing that's giving you a consistently profitable account. And you're already at the point of, okay, do I really want to double down on trading and really see where we're going next? Or am I okay with 30, 40% growth per year on my account? Or am I trying to be, the next Warren Buffett? You play around with it, of course, something new and exciting. But anyway, off topic. Benedict asks, what is the best numbers for stochastic indicator on 1 hour or less time frame? Benedict, we just went through the stochastic in that way. It depends on the market situation. In this case, we found out that for the pair euro-US dollars on 4 hours and 1 hour, at the moment, the signal seems to be cleanest when we have the setting of 23 and 9 on a linear weighted close setting. That could be different when the market changes. So you need to understand your indicators are not a fixed thing. You need to understand market changes. So when the volatility is all over in 2,500 years, then you change it back to what it usually is. It's, I think for euro US dollars usually are like 14, 4 and 6. I think that's what I usually use. And I usually had it on smooth it. But that was because the way that I was combining it with other indicators. Just one indicator is not enough. See, stochastic is a mix of two moving averages. So it makes sense that you have an RSI intact that also has a moving average. And for instance, a double or triple moving average in the chart. So now you have two oscillators working on moving averages doing the similar thing differently, because this one might give a false signal when the other one doesn't, and the other way around. And then you have a moving averages, which is the typical like cross line reading. So now you have three indicators telling you when it's go time because they need to line up. And only then you go in. So it's another layer of, well, you might miss a few trades. True, but we're not trying to make every trade. We're trying to make consistently good trades. I think that was the point we were trying to do. We're trying to grow our account, right? We're trying to get out of that hole that we dug ourselves. That's priority number one. You know, some people are $500 in. Some people just started and have nothing in. And the worst one I've ever had was $500,000 in. So before you even can talk about I'm making profit on trading, you need to get back $500,000 because that's what you already put in it. Like, it's not like this account's making money. No, it's not. You're still getting back whatever you lost in the other ones. Right, so numbers. So you have to understand market situations and change it. Right now, 23.9 seems to be pretty solid when we look at past historical data in the current market situation where the signal seems to be pretty clean. But I would combine it with something else. I hope that answers that question, Benedict. Which gives precise and close. Yeah, so like I said, right now it's 23 and 9, top of my head. And normally it would be like 14, 4, and 6. That's what I used. But then 14, 4, 6 is also smooth. It's actually, I think the standard, apart from that I slow it down a little bit. Because I want the signal a little bit later, because I wanted to line it up with my RSI and my moving averages, which are usually a bit faster. So then they line up at about the same time. Oh, do I still have a little bit? Sorry, I have a little bit of a dry throat from all talking. Okay, Joanne, okay, that makes sense. I hope that answers your question, by the way, Benedict. Do you use simple or exponential moving averages? Good question, Richard. It depends on how my setup is. But if I'm using the combination of RSI, Stochastic, and MACD, then it's simple MAs. Because RSI really uses exponential and so does Stochastic. I don't want too many exponential MAs in there. Right? Exponential MAs move faster but give more false signals, so you want to slow it down with something else. If my triple moving average is set up for exponential, then I'm not using Stochastic and RSI on an exponential. I use them on simple, right? So they switch from each other because you want to have the same information done differently, so you have multiple signals giving you a green light based on multiple different factors and calculations. Oh, that makes that answer. I hope that makes sense. consider it as if I want to have 6 different opinions on the same thing, but the opinion needs to be formulated through the same flow chart. Does that make sense, what I just said? I think it makes sense. Makes sense to me. What do I use for divergence? Again, different things. It depends on the currency, depends on the market situation. Sometimes I don't do it at all, which is a bad habit. It depends on the market situation. Oh, what time is it anyway? Oh shit. We're like half an hour over already. Yeah. Remember things. I learned so many things and great stuff. Cheers. You're welcome, Venu. Have a great one. Well, like I said, my standard setup is already RSI MACD, and then I have a stochastic in there, and then usually a triple moving average setup. That's usually for the majors. I use something a little bit more. No, I still use that for minors as well. Exotics, I usually had a different approach, and it was really depending on the exotic, was more like shifted towards fundamental because exotics are a little bit more tricky that way. But so basically, I already had that through those 3 setup. Like you already see when the MACD and the RSI are giving you similar information, but they're diverging from each other. So they're both giving you a signal, but the one says sell and the other one says buy. Then you have the stochastic giving you a third signal, which is going to be hooking up with one of the two. Or it could be that the signal line and the trend line are going away from each other. Then you know absolutely for sure that this is not a trade to do right now, because the market's just like flipping the volume way too much. Like we're diverging in both directions at once. So you wait for something to establish and then you go. Unless you're confident in knowing where it's going to establish, and there's other ways to tell that, because then you start going into, technicals, you look at price levels, supply demand zone, stuff like that. But yeah, again, yeah, you can use a histogram in there, sure. Again, it depends on personal style as well, personal preference, to be quite frank with you. I've always been more technical than I've been fundamental. I just forced myself to learn fundamental because I just found out it does matter when you get to a certain point. Like if you want to advance past a certain point at some point, then you have to get that in there as well. But to have a profitable account, you don't need it. Neither doing divergence. You don't have to. One of the webinars I did, I show how with risk management and using a variable lot size setup, you only need 40% win rate to have a profitable account. That's literally worse than throwing a dartboard at the chart and hoping it hits buy or sell. Yes, fundamental drivers. I know where you're going at, Richard. You're correct. But let's be honest, right? Price points on a chart, drawing a line on it is not going to mean anything. The problem is that the people that draw these lines trade on those lines. So you have to understand, like, okay, there are price levels, which the bigger companies use, obviously, right? They use pricing points for strike dates and stuff like that. And then the technicals, yeah, are derivative of fundamental past points, but that it's like a self-fulfilling prophecy, right? Because the market judges them based on those historical values and thus starts putting pending orders and stuff like that. And, because of that, it's a self-fulfilling prophecy. Now, that's based on fundamental drivers, and you're absolutely correct. When we talk about economic calendar fundamentals, because there's a difference between the two, this is only for creation like spiking, unless it is a driver announcement. For instance, a interest rate decision, right? Makes sense. Where you have a bearish market and they go for a hawkish hike, you can expect shit to hit the fan. I hope that makes sense. Because that's also those times when your trade is not stopping at a line. Because you just had a whole big investor deck going like, oh, that's interesting. Oh, okay, we'll put 150 mil on it. Oh, that shifts the volume slightly. Then a line on the chart's not going to stop anything, or all the pending orders along the way. Right, market makers, different story. But yeah, it's a nice discussion to have actually, Richard. But I don't know if you agree with me what I just said, or if it makes sense what I just said, because sometimes I just say things that make sense in my head, but try to always explain it in a way that everybody understands it. God, my throat's getting really dry. Does anybody have any other questions? Or did everybody just fall asleep? Or did I lose everybody because it was like, okay, I have no idea what he was just on about. No, nobody? Everybody good? Jacques. Oh, yeah. Good. Thank you for reminding me. Where the you mean the oil question? Yes, Richard, I do more webinars. Right now, Legacy FX asked me to do the same webinar 3 times in a month. So it's going to be this topic 3 times for different approaches, but at least the first week, the second week of every month is the internal Legacy FX one, where for just for the clients from Legacy FX. So it should be the first of every month. You should have a new one, and some months we have 3 different topics. So I have 3 webinars in 1 month. So this month I'm repeating this one on the 21st, I think, or something. Yeah, next month for sure around the 10th again, a new topic. They also have, I happen, obviously I know this, Legacy FX put me in their loyalty thing that they have. Like you can sign up for a loyalty thing, you get points or something. I'm not quite sure, I'm not part of it, but I'm in there as well. So I'm one of the one of the rewards you can claim. It's like a one-on-one private webinar. So you can ask any topic you want. I'll make the content. Study up on it if I need to, because if it's something that I'm not that familiar with, then I'm, usually with my experience, I can figure it out to a decent degree. And if I can, I'll just tell you. But yeah, there's that as well as a reward. So you can claim me instead of an, I don't know, USB stick or something. It's like an hour session, one-on-one. So there's that to consider. You can make your own private webinar. Okay, so Jacques, your question. I am sorry for the wait. No, where do you look for channels? On which time frame do you look for channels to help you find tops and bottoms? All right, Jacques. Top-down analysis. You start in a week, you then do a day, and then 4 hour or an hour, depending on where you execute. Now, for the question, and trade within the channel direction, well, when you open the trade on an hour, you trade it on an hour, right? That's your hourly, like bouncy bounce, depending on where your take profit is. But like I said, I usually open the trade, and once it's open, I micromanage on a day. I don't care what it does in between. It's going to go up. It's going to go down. I don't really care. What I do care about is where it eventually goes, because once you go back to this example, right? Once you've opened the trade, this buy that we did over here, right? Let me go back to, hold on, I got a whole bunch of windows in my, over my chart there. So we did this. So you have this angle, right, that I did, that is based on the average growth in a downtrend. So you can just follow that line to your take profit line like this, and it will tell you 10 bars. All right, this trade should take about 10 days to develop. Could be faster, could be slower, but on average should be about 10 days. So I'm not going to look for 10 days long for every hour. I'm going to watch 240 hours of meandmychart.com. I'd rather watch Netflix in that case. I mean, I love trading, but I'm not going to stare at a chart for 10 hours straight. And the same one on that. It's just going to drive you nuts. Green candle, red candle, green candle, red candle, green candle, red, red, red. Oh, shit. So to be simple, you start on a week. You set up your trend. You go to a day. Right? And then go for an hour. This is just for execution purposes and maybe to fine tune a little bit along the way. Let's say what somebody said earlier, like let's say it has a pullback within an uptrend, right? So you're in an uptrend, it pulls back. When do you judge for a new entry? So let's just, for pity's sake, say this is the uptrend and the trend is like this. It's not, obviously, but let's say it's like this. You went up here, your trade is developed, you have a trailing stop, that trailing stop, this is your entry, your trailing stop. What is this? Oh, that's the actual trade I opened. Whoops. Look, I made money. Your trailing stop is now, well, I don't know, somewhere over here. Then you can now say, okay, we are here. This is my trend. We're at the bottom of the channel. There was a recent rest here that is also a little bit here. There's no other points to connect it by, but this is clearly something that I got stuck on. Now the judgment is it this point based on this wick, or is it this point based on these two? A little bit loose, but I would take the safe one, so take the lower one because we're buying. Then you open a new trade. You put the stop loss here. Your other trailing stop is already here, so you're already, you know, having secured at least this profit, which covers this gap. Am I going too fast, or is everybody with me here? Right, and then I just go back to a day. So this is only if I want to add a trade to my existing trade that I do that. But for the rest, I just do everything in a day. Unless this angle is based on a day and the trend is really good on a day. So you have a, where's my trade? Oh, this is the trade. Is this a trade? Or is this my, what's this? That's my stop loss. Oh, this is my trade. Right, so unless I have, let's say, and this is going to be really quick and dirty, by the way. So entry, let's say this is my channel, and I take the buy every time it gets to the bottom, and I'm looking at a day, and obviously on a day this doesn't make any sense at all, but it makes sense in an hour. So if I'm really short-term trading because I'm feeling frisky, then you know you sell here, you buy it here, you close the sell, you close the buy, take the sell. It goes back up, so you close it. And then this is one of those examples where 1, 2, 3 winning trades, and the last one, the fourth one, you lose because it breaks out of its own channel. Okay, so again, consistency. I'm winning 3, I'm losing 1, just by taking every trade. But generally speaking, let's cut out the risky ones. Right, you're in an uptrend. Let's say this is the uptrend, and we're not in a downtrend, but let's just say we're in an uptrend. You take all the buying opportunities. 1, close. 2, you would have probably closed it here. and you were looking at re-entering here, but you obviously didn't because it was a wick. So you had 2 out of 2 trades and you won, and it broke out of its own channel, and you're like, oh shit, I should have held this trade. Yes, you could have doubled it, but you're more consistent because this, how often does this happen? And how often does this happen? Well, the answer to which one is more often, that's the one you trade for. Yeah, so you look for the larger trend because the large trend determines what the small trend does. The small trend is only a development into the large trend. Again, if that makes sense. I'm like cutting a lot of corners here. Heiken Ashi chart. Yeah, I've never really used it, but yeah, I know what it is to a degree. I never use it, and also for mentoring, I don't use it. I teach them just the basics. Like if you really want to do it without any learning, it's sort of okay. I wouldn't be a great fan of it. I'd rather have somebody go like, okay, let's learn the proper rules for technicals. It's not rocket science. It takes a little time, but it's not rocket science. And yes, the fine tuning comes in experience where the one time it's this and the one time it's that. It's the little dots on the eye. But getting the main foundation and the first story build of the house, that's not rocket science. Getting the roof on it, yeah, that's a little bit different. I'm sorry, I like to speak in those kind of terms because everybody understands what I mean then. Instead of going like really technical. I'll answer the question, Benedict. Sabata asks, please analyze the market using top-down analysis, the whole process, just for us to see how you set up trades you take. Well, Sabata, I don't have to do that here because you can go to YouTube and type in Legacy FX, and I actually did a video on that. Technical analysis. I think it's called, I think it was a series, Technical Analysis 101 or something like that. So episode 1 is how I do top-down analysis based on just technical trading. So how you make trend lines, color code them, resistance and stop losses, some of the rules that go with that. Again, it's not as super advanced as it can be, but it will give you it'll get you 70 to 80% of the way. You're not going to learn the little dots on the eye that I mentioned before. And then there is the second one is price action, if I'm not mistaken, in that series, and the third one is indicators. That pretty much gives you the whole kit to start with. So YouTube, Legacy FX, check out the videos, give a thumbs up and subscribe and all that fun stuff. I'm saying that for them. I mean, I'm not involved in any way in that, but there you have it. It's already there. Just look it up on YouTube, Legacy FX. You can do it in your own time, pause the recording. You can do it, you can copy it. Just go back in the chart and copy exactly what I'm doing so you understand why I'm doing it while I'm saying why I'm doing it. Right, hope that makes sense. Oh, okay, well, we got there. Okay, I'll ask it one more time because it's getting... Okay, we way overshot this webinar. That's okay. Anybody have any final question that is burning? I just get thank yous. So I'm going to assume that everybody's okay with today's content. So let's just wrap it up, guys. And girls and whatever you identify as. I'd like to thank everybody for being here tonight, and I hope you learned something. Remember, usually it sends out the survey. It'll help me a lot and helps Legacy FX, obviously, getting a good understanding of what you guys want to see and want to hear. And from my side, obviously, it helps me get a little bit of a good idea of where I can improve. Generally, content-wise, me-wise. And like I said, it's anonymous, so feel free. Having that said, everybody, have a great evening, day, morning, wherever you may be. And I hope to see you on the next webinar. And like always, trade safe and trade smart. Cheers.